Hi everyone, today's video is on Alibaba, ticker symbol BABA. Chinese conglomerate, pretty famous, so I'm not going to go super in depth on it. It owns AliExpress, Taobao, Tmall, massive e-commerce segment in China, and also owns cloud computing operations. A really interesting company, very similar to Amazon. I'm going to analyse the stock, illustrate with some basic valuation metrics, have a look at the debt and things like that. Then I'll move on to the quarter 3 report, see how the company's guiding for the future, and do a DCF to look at the intrinsic valuation and where it sits in regard to its fair value. I'd appreciate it, before we carry on, if you could remember to like and subscribe if you're enjoying the videos. Thanks. So as we speak, Alibaba's sitting at pretty much all-time lows, depending on the time you look at this week. And this is mainly due to some lukewarm results and from a regulatory crackdown by the Chinese government on lots of stocks. You know, the edtech industry, education, for-profit industries took a big hit. Real estate groups took a big hit. It seems like the Chinese president is just tightening his grip over the country's economy and cracking down on a lot of business practices they don't agree with. There was the Ant Group IPO cancellation based around Alibaba, Jack Ma's disappearance, a lot of US versus China posturing and threats of delisting. I mean, there's a lot to unravel and a lot of reasons to be bearish on Alibaba's near-term future based on this regulation. But in my opinion, there's a lot of reasons to be positive. As I mentioned, lukewarm guidance and a particularly bad reaction to that guidance. They mentioned some headwinds due to increased competition, increased spending, and they're now guiding for only 20 to 23% growth. This is for, as you'll see in a minute, a 20p company that's valued in the 300 billion. So that's pretty impressive if you ask me. But the stock market, just when it rains, it pours, and it's definitely pouring on Alibaba at the minute. So looking at its 5-year chart, it's currently at its lowest price since 2017, down from its high of 218 this year, down to the 52-week low of about 136. Struggling this year, the stock is struggling. The business is doing fine, but the stock is taking a hit for the reasons mentioned. So looking at some financial metrics, excellent cash to debt is one of the real strengths of Alibaba. It's got an excellent balance sheet. 3.2 is an excellent cash to debt, particularly for this industry. As you can see from the versus history, it's not the best Alibaba has ever been, but it's strong. Generally, debt is very well covered. This is a relatively financially strong business. Altman score of safe. This is fully investable levels of debt, cash to debt. Profitability-wise, it's 20% net margins. Not unbelievable, but very strong for the industry. Operating margins of around 11%. Again, not unbelievable, but very strong for the e-commerce industry. This is obviously supplemented by the cloud computing segment. Return on equity, strong. Everything financially about this company is looking really strong at the minute from these high-level metrics. Looking at some basic valuation metrics, the PE ratio of this company is around 16 on a trailing basis, 15 on a forward basis. That's compared with the PE of the S&P, which is around 32. This is tremendous, half of that, and this is, as you can see by the versus history, this is pretty much the cheapest Alibaba has been on a PE ratio ever since it's been in the public market, so it's looking really strong from that basis. And also the PEG ratio, so this demonstrates the price versus earnings growth. Again, some of the cheapest it's ever been, and based on all valuation metrics, Alibaba, as you can see from the green lines in versus history, Alibaba is looking as cheap as it's ever been historically, far below its average, and is looking really cheap. So it's an excellent PE versus the market, and this shows the relative strength of the business right now versus the past. So looking at the quarter 3 highlights, revenues up around 30%, China commerce 30%, international commerce 34%, and cloud computing 33%. Annual active customers up 62 million. That is a huge amount, and that has now 1.24 billion global active customers, which is absolutely crazy. Profitability is increasing, so all these numbers are in Chinese yuan. So Alibaba don't really post these type of metrics in dollars. So for information, 6.4 yuan is roughly equal to $1. So divide everything by 6 to get the dollar amounts. 30% revenue growth at this scale is tremendous, and as we're seeing from those valuation metrics, you don't often see 20 PE companies growing 30% revenue at any scale, never mind this type of scale. So it really shows the concerns of regulation and delisting. It's very much a global company. It has 285 million international users, so AliExpress and things like that. So it's insulated slightly from diversified outside of China. So it's kind of insulated from the Chinese problems, but not really. The majority of its revenue comes in China, but it does have a nice amount of diversification, in my opinion. The cloud computing segment is great, and it's one of the leaders in this industry in China. So breaking down revenue more in depth by segment, again, all these numbers are in Chinese yuan. Just divide by 6 if you really need the dollar amount, but it doesn't really matter. What matters to me is the percentage amount, and we're seeing a year-over-year increase in pretty much everything by strong numbers. And bear in mind, this is considered not incredible quarter, and total commerce grew 30%, which is a tremendous scale. So this is total revenue. It says 200 billion Chinese yuan. That's about $30 billion. With cloud computing is now around 10% of this, so that's about 3 billion quarterly, which is absolutely nuts, growing 30%. So this is the scale of this company boggles the mind, really. And if this was a Western company, it'd be easily over $1 trillion, in my opinion. But again, that's the topic of this video is it worth it with the risks? So it also gives the 6 months end, and it's performing strongly again, like numbers above 30% year-over-year growth. Pretty consistent growth quarter over quarter, and not accelerating and not decelerating, just wholly consistent. Cloud computing and total commerce up 30% each. These are excellent numbers for a company at this scale, like really, really strong. You can see that the commerce numbers for retail are dragged down slightly by wholesale. This is to be expected because the supply chain issues and moving goods around the world is a lot more difficult. But overall, these numbers are absolutely excellent, and like lukewarm guidance or not, these numbers are absolutely tremendous when looking at the valuation of the business and comparing it through that lens. So just digging in a bit deeper on the commerce segment, which is clearly the biggest. Revenue from the commerce segment was around 30% increase, about $26.5 billion, which is tremendous scale. China commerce still really strong. International commerce segment grew 34% above the Chinese commerce segment, which is really nice to see. Diversification, as I mentioned before. Profits down by about 12.6 billion Chinese yuan, but that's still really strong in dollar terms, 5.1 billion, and we're seeing that as a net loss, like crazy to me. Gross merchandise volume up for a lot of the retailers. They're seeing a lot of accounts, now over 240 million annual active customers on Taobao alone. These are just really tremendously strong numbers. And this is in addition to the continued share repurchase. So they've repurchased $5.1 billion worth of shares. So this is, as of we speak today, this is like a $370 billion company. So that's a chunk of change. Like, that's in the low single-digit percentage numbers. That's a real chunk of change, and this is what they're doing quarterly. So they've recognised that their share price is really low, and they're buying back shares. What I would say quite aggressively, not aggressive based on the cash flow numbers, but aggressive compared to other companies in the world. This is 5.1 billion in share buybacks for a quarter is really, really quite a lot. And I'm glad to see this, that they're backing themselves. You can only really expect to invest in a company if it backs itself, in my opinion. So looking at the most important metric, in my opinion, which is for this type of company, which is like a DCF calculation, trying to work out some intrinsic valuation. So I don't think, looking at the right-hand side, the annual rates per share, I don't think EPS is going to grow at 53% a year. I think 22.6 in the 5-year rate, that's probably about right. So I used 20% for the growth rate and added in a discount rate of 8%, which is roughly the annual return of stocks every year. And this gave a 60% margin of safety and a fair value of $345 compared to today's value of $130. So, you're looking at easily doubling your money. It's like 150% return in an ideal world, which it obviously isn't. So the question is Alibaba worth the risk? In my opinion, I'm really unsure. I think this is getting to the point where it's getting too cheap, in my opinion. Like, the regulatory risks are definitely there, but I don't think Alibaba is going to be delisted, and I think the US and China will eventually figure out some sort of arrangement to increase financial reporting for Chinese companies. Alibaba is the absolute premier Chinese company, in my opinion, along with Tencent and JD. This company has a lot of room to grow. I think the regulation risk will, in the end, be hopefully a bump in the road for Alibaba. And I think at these sort of prices, it really is getting quite tempting to be because the possible gain with a relative margin of safety, talking about 100% in your money and still having some room to go, this is a tremendous company, a rare buying opportunity in my opinion. And I really have my finger hovering over the trigger at the minute. I'm just not sure if this is the bottom. I try not to time the markets, but with the current market as it is, I think this could be a nice company to have if growth stocks continue to plummet. I think it's overall, I would bet handily that Alibaba is going to be a larger company in 10 years. And if I'm not worried about a delisting, then isn't that really all that matters? So anyway, if you appreciate the video, again, please like and subscribe. And let me know what you think about Alibaba in the comments. Again, I'm like really sitting on the fence on this one. Finger hovering over the trigger. It's firmly on the watch list. And if it goes much cheaper, I think I'm going to have to buy just to be a part of this story. Okay, thank you.